Online at pointofview.net.
Hi, this is Brad Dacus of the Dacus Report, heard weekly on Bible School Radio 91.3 KDKR Decatur, Dallas, Fort Worth, and on 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, what are the 15 things to keep in mind for 2022 tax filings season? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, April 15th is around the corner. Are you doing all the right things when it comes to your taxes? Well, today Dan Pilla is with me to talk about the 15 things you need to know. Dan, welcome to Prudent Money. It's always great to have you, especially at this time of the year.
Well, it's my pleasure, Bob. Thanks for having me. Yeah, and this is a busy time of year for tax compliance, no doubt about that. And let's see if we can do something to help.
Yeah, and by the way, I want to mention that the article that you originally wrote is on the website today at prudentmoney.com, so people can go check that out. Let's talk before we jump into the 15 things we want to talk about today. Let's talk about someone who is filing and they're due to get money back. And there's always, what's the best way to do this, especially with the IRS kind of in their current disarray. What steps should someone take to reduce that time of getting that money back?
Well, the fastest way to do it, Bob, theoretically, is to e-file the tax return. That gives you a couple advantages. First of all, you get confirmation within 24 hours that your return was either accepted or rejected by the IRS. If the return gets accepted, Bob, they tell you, they give you an acceptance number, a confirmation number, and so now you know that the return has been received by the IRS. Now, that's important for a couple of reasons.
Yes.
First of all, it confirms that that's the fastest way to get your refund. But the other thing is the IRS has still backlogged millions of returns in processing, and a lot of those returns were e-filed tax returns that they're backlogged. Now, why they would be backlogged with e-filed returns, I don't know, but they certainly are, Bob. There's no question about that. So if the IRS comes along and they try to charge you with a penalty for late filing, that e-filing confirmation number is going to prove that you in fact filed the return on time. So that's a big deal. Now, if your return is rejected and they do not accept the e-file tax return, and you end up having to file a paper return, obviously that slows everything down. But make triple sure that if you paper file your tax return, you send it by certified or registered mail or U.S. priority mail with tracking, and keep your postage receipts, because date of mailing is considered date of filing when it comes to failure to file penalties. So even if the IRS doesn't process your return until next June, if you can document that it was mailed by the deadline, which this year is April the 18th, not the 15th, if you can document that it was filed on time, then you don't get charged with penalties, Bob. So it's a big deal.
Well, let's start with the very basic, which is the due date of the return. I mean, this is kind of a moving target depending on when that day falls. Talk about the filing deadline date for 2023 for 22 tax return.
Yeah, ordinarily we think April 15th, but this year April 15th is a Saturday. And April 17th, and in that situation goes to the next business day, which would be April 17th, but that's a holiday in the District of Columbia. So now it goes over to the next business day after that, which is April the 18th. So that's why the deadline for filing is April 18th, and it doesn't make any difference where in the country you live. The April 17th is a deadline, holiday in the District of in Washington D.C. And so that's why we're going over to the next business day, which is the 18th.
So I hate to ask this question. Why does D.C. have its own holiday?
Well, it's like some states around the country, Bob, have their. I guess they have. There's a Patriots Day in Massachusetts. They have their own holiday. So there's a few places around that have their own holidays that others don't. So it's because it's a holiday in Washington D.C. Then we go over to the next business day. So that is.
Okay, there you go. Okay, well, filing an extension is we've talked about this, a very misunderstood process with the IRS. Talk about the wrong assumptions that people tend to make.
Yeah, the wrong. First of all, let's talk about the basic rule. The basic rule is that you can get a 6-month extension of time to file your tax return, and that's easy as pie. It's as easy as falling off a log. All you do is submit Form 4868 on or before the deadline, which this year is April 18th, as we said. When you submit that form, you automatically get an extension of time to October 15th. Of course, this year October 15th is on a Sunday, so that again goes over to the next business day, which would be October 16th. That's the deadline to file your return if you get that extension. But getting the extension of time to file your return, and this is where the misunderstanding comes in, getting the extension of time to file your return does not extend the due date for paying the tax. The tax still has to be paid by April the 18th, all right? So it's not a payment extension, it's a filing extension, Bob, and this is what people need to understand.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Dan Pilla is here to talk a little bit about the 15 things to keep in mind for taxes for 2022 filings. And if you want more information on Dan, taxhelponline.com is where to go. And I have the article posted at my website at prudentmoney.com. Let's say that you don't have the money to pay your taxes. You're in kind of a bind. Things happen. Why is it still important to file on time, even if you can't pay for it?
Well, yeah, that's a good question, and the short answer, the one-word answer to that is penalties. When you don't file the return on time, the IRS assesses a failure to file penalty in addition to failure to pay. The failure to file penalty, Bob, is 5% a month, capped at 5 months or 25% of the tax liability if you don't file the return on time. The failure to pay penalty is another maximum penalty of up to 25%. That's assessed a little bit differently, but it still carries a max of up to 25%. So if you don't file your return, you potentially double the penalty load that the IRS is going to heap on. So what starts out as a difficult situation can turn into an impossible situation if you don't file the return on time, even if you can't pay the tax. And so it is very important not to use the explanation that you didn't have the money to pay as the reason you didn't file the tax return. That is just not going to work. File the return on time, even if you can't pay the tax, minimize your penalties, and then understand that there are specific ways, options, strategies for dealing with the collection situation once that arises, but you add insult to injury if you don't file the return on time.
Now, this next one, I don't even think that I really know what this means. What do you mean by the FBAR filing deadline?
Yeah, the FBAR filing, what I'm talking about is FBAR. The foreign bank account reporting requirements are separate reporting requirements that kick in if you have offshore bank accounts. If you own bank accounts in a foreign country or a financial account, it doesn't have to be a bank account, a foreign financial account that has more than $10,000 in it at any point during the calendar year 2022, you've got to file a separate FBAR report, and it's a FENSEN Form 114 is the so-called FBAR form. That also has to be filed by April 15th, but that's not filed with your tax return. That's filed with the Department of Treasury, and it has to be filed, e-filed through the Department of Treasury's e-filing center. So you got to go to the FENSEN website and get that filed. And that is a critical form, Bob, that has to be filed for anybody that owns offshore financial accounts.
Let's talk a little bit about digital asset transactions. First, maybe what that is, what you're referring to, and how do you go about reporting that?
Well, yeah, digital asset reporting digital asset transactions is a big deal. In fact, there's a question on the tax return now on Form 1040. There is a question on the return, and to give you an idea about about how serious the IRS is about collecting information about digital asset transactions, is there the question is question number 7 on the tax return, and it comes right after your name and your address and your city and state and all that stuff. So it's at the tippy top. to use the words of Ocasio-Cortez, it's at the tippy top of your tax. That's a technical legal phrase there,
yes,
Bob.
that's what I gathered.
It's right at the top of your tax return. You know, it's not a separate schedule. It's not buried in the fine print. It's right at the top of the return. The question asks if you had any activity in or engagement in any digital transactions. And when we're talking about digital assets, we're talking about things like cryptocurrency, Bob. Any cryptocurrency or Bitcoin or any of that stuff. I mean, there's 100 different cryptos out there now these days, and any of that stuff is considered digital assets. And all of it, well, I shouldn't say all of it, but a good deal of it has to be reported. In my February newsletter, I have an article in there that specifically talks about reporting digital assets and what you have to do and the circumstances under which they get to be reported. But here's the thing that people don't understand about digital assets. The IRS treats digital assets just like any other investment asset. All right. So if you buy let's say you buy cryptocurrency X for $10 and you trade that currency over the course of 2022 and you traded it and you got back, $11, you've made a $1 capital gain on that transaction. If you purchase cryptocurrency for $10 and you trade it and sell it off for $9, then you've got a capital loss. If you have, and here's what confuses people, and this is, I mean, you need to get this straightened out in your head. My article will help you with this. But if you're not sure, you need to consult counsel, because if you traded a crypto asset, let's say you had a crypto asset that you paid $10 for, and you traded it for two other crypto assets, a different variety of crypto asset. Even though you traded the asset, Bob, and you didn't get cash back for it, that's still considered a sale disposition. So it's as if you sold your crypto asset of crypto asset X, and you bought 2 shares of crypto asset Y. That is taxed as a sale. All right, and the sale is equivalent to the cost of the 2 assets that you got back in exchange for the asset that you gave up. And so in that situation, depending on the value of the assets that you got back compared to what you gave up, you might have either a gain or loss, even though you didn't actually do a sale, right? So this people are treating these crypto assets as if they're U.S. currency. You know, you got the asset, you traded for this, you traded for that, and that's not how they work, Bob. They work like you have to think of it as a stock or a bond, right? This is a capital asset that has separate value, and you're taxed on the gain or loss on that asset at the time of the trade. I'll give you an example. So people are buying goods and services in the marketplace using their crypto wallets, right?
Sure.
And so if you walk into a McDonald's, and I don't know if you can do this, but just hypothetically, if you walk into a McDonald's and you use your crypto wallet to pay for your Happy Meal, Bob, we laugh at this, but it's true. You have a potential capital gain or loss that has to be reported on your tax return based on the value of the crypto asset that you gave up to get back your Happy Meal. All right, this is a trade of a capital asset for goods or services, and it is a potentially taxable transaction, and people don't realize this. And I'll tell you something else. Crypto audits. So the IRS is saying, oh, we're going to be auditing rich people and we're going after rich people. That one of the top things on their audit list, Bob, is crypto transactions. Not rich people, crypto transactions. I'll tell you, it seems like to me, based on my conversations with my son, it seems like to me that every 20-year-old in the country, every 20-something citizen in America is dabbling in crypto assets. Do you agree with that as a financial advisor?
As the dad of a 21-year-old, yes, I agree with that. Yes.
All right, great. So we're on the same page.
Well, but
every 20-something.
Go ahead. Sorry. I was going to say, the problem is, at least what I found, is that this isn't like doing cost-based accounting for a mutual fund. I mean, it's a lot more in depth, and from what I understand, you don't get that much information from the companies that do the transactions. So the burden of proof really kind of falls on the owner, right?
Yeah, that's absolutely true, and that's true whether you're dealing with stocks that are traded over the counter or on the New York Stock Exchange, or if you're trading in gumballs. The burden of proof is on the taxpayer to establish what their basis in the asset is. But getting back to this 20-something problem, I believe that every 20-something kid in America is trading in these and dabbling in these cryptocurrencies back and forth, and I'm telling you, Bob, they don't have a clue, for the most part, do not have a clue how those assets are going to be taxed and how that stuff is going to be looked at by the IRS. Now, and so they need to know, all right? They need to learn this, because they're going to find out the hard way that this is just not as clean and as simple as they thought it was. And as far as records are concerned, it seems like to me, now I don't have a lot to do with this stuff from a first-hand experience of buying and selling, but it seems like to me that it depends on what clearinghouse, and I don't even know if that's the right word for these crypto centers.
That's the right word.
Okay, it depends on what clearinghouse you're using that handles your crypto trades. Some of them, just what I learned from our tax return preparation business here, some of them are better than others. And I think that's one of the things that you should be looking at, is what kind of reports do they give you on your trades, because the more detailed, the better, because exactly what you said, Bob, the burden of proof's on the taxpayer.
So unwind this one for me. You'll love this one. Blaine goes to Mexico for a competition, comes back, and says, "Dad, look at my boots that I bought with my crypto." I mean, how do you unwind that one? Explain that one.
And that's a good question, and that's the example I gave with the Happy Meal, right? I mean, what's the difference between buying boots in Mexico and buying a Happy Meal in Plano, Texas? It's exactly the same tax consequence. So the question is, what was the cost basis of the crypto when he bought it? What was the fair market value of the crypto when he traded it for the boots? Because that is what his capital gain is at that point in time. That is the disposition, and he's taxed either a gain or a loss on the transfer of the asset from crypto to boots. It creates a capital gain or loss. I'm telling you, Bob, this is going to be a massive problem for these kids. And don't think the IRS is going after rich people with this crypto stuff.
Oh, sure.
They may be doing that. That's very possible, but I guarantee you, rich people have hot shots, CPAs that know exactly what they're doing to keep them from getting sideways, and guys like our sons don't have that.
Let's talk a little bit about the standard deduction. First of all, let's take a step back and maybe explain what that is, because I'm not convinced that everybody even knows what that really is. And then the amount of standard deduction that taxpayers will get for 2022.
Yeah, the standard deduction is a deduction from income that every taxpayer gets just because you have a pulse. All right, and so what it is it's a way of reducing your tax liability to account for the basic necessary living expenses that a person has to incur, and so the IRS says, well, or the Congress says, well, let's give a break here that will be effective for most beneficial for the lowest income taxpayers, and they're going to get this deduction even though they don't have to prove that they spent money on business or taxes or any of these things that might otherwise be deductible. You get this basic deduction called the standard deduction, and that reduces your tax liability and reduces the burden on lower income taxpayers. So that's what the standard deduction is. Everybody gets it. It's a check the box thing, and so you don't have to prove it. You just either claim it or you don't. Of course, you want to claim it. And the amount for 2022 is almost $13,000, Bob. It's just under $13,000 for a single person or married filing separately, and it's almost $26,000 for married filing jointly. So it's a pretty significant deduction. So I mean, just think about this for a minute. If you're a young person, a 25-year-old, you're out there making $40,000 a year. Well, the first almost $13,000 of that money, if you're a single person, is not taxed. All right, so that reduces your taxable income by the amount of the standard deduction. Now, you have the choice. Taxpayers have the choice between a standard deduction and a itemized deduction. Itemized deductions are things that you claim for mortgage interest, charitable contributions, state and local taxes, medical expenses if you qualify. All of those separate deductions are itemized deductions. You don't get to claim both. You claim either the standard or the itemized, whichever's greater. So you add up your itemized deductions and you say, well, are my itemized deductions more than the standard? If so, I'm claiming itemized. If not, I'm claiming the standard. So the standard deduction is the basic claim that you get. Itemized deductions are over the top, but the key difference is you have a burden of proof on itemized that you don't have on standard. You don't have to prove anything for standard.
I think that a lot of people who who listen, who tie to their church, just automatically think that this is a tax deduction, and it really may not be.
Well, it may not be if it doesn't exceed the standard deduction.
Sure,
for
which
example,
is quite a bit.
If you're married filing jointly, Bob, you've got a almost $26,000 standard deduction. If you're giving $10,000 a year to your church, God bless you, that's a lot of money, but $10,000 is not more than 26. So you're better off claiming the standard deduction of 26 and forgetting about the $10,000 itemized deduction, because you'd literally be giving up almost $20,000 worth of deduction if you claim the itemized. Why would you do that?
Yeah, I just don't think a lot of people know that. Let me ask you a question, Dan. Are you free tomorrow to come back and do the other half of the list?
We can. Let me look, Bob, very quickly to see what I got going tomorrow. And
I'd love to have you back on to the program.
Yeah, I can talk to you tomorrow afternoon. Yes,
okay,
I can.
Great, because I want to do the other part of this list and maybe talk a little bit more about digital assets. I think this is great information. You can get more information on Dan, taxhelponline.com. And Dan, you're always a wealth of information and a blessing. So appreciate you coming on.
My pleasure. Thanks for having me.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. Dan will be back on the program tomorrow because we still have 7 through 15 of things to keep in mind for the 2022 tax filing season. And like we were talking about, that's coming right around the corner. You want to make sure that you get that right. And with things kind of in disarray at the IRS, you want to make sure that you are very careful with dotting the I's, crossing the T's, and making sure that you have everything in order the way they like to have it, and to make sure that you get it done right. Hey, this is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.